Over the past year, the US economy has not been operating in a stable environment. It has been absorbing one shock after another. Tariffs keep changing. Interest rates remain high enough to pressure businesses and consumers. Public debt has risen sharply. Student loan payments have resumed. Tens of thousands of workers have been laid off, then rehired. And for many small businesses, there is a constant sense of policy uncertainty. In many other economies, just part of that chain of volatility would be enough to slow growth or even push the economy into recession. But in the US, that still has not happened. GDP is still growing, markets are still near their highs, consumer spending has not fallen as sharply as many predicted. So the question now is no longer, is there instability? It is this: what is keeping this economy from sliding, and who is paying the price for that stability? In this video, I am going to break down 3 reasons why the economy has stayed resilient so far. First, what pillars are holding the economy up and preventing a deeper slowdown? Second, why those same pillars may be making growth less durable beneath the surface. Third, how this may affect investors, small businesses, and workers over the next 12 to 24 months. Stay until the end, because I am not just explaining why the economy is still standing. I'm going to give you a broader framework for reading the economy right now. What is real growth? And what is growth being propped up, so you do not get fooled by strong-looking headline numbers? The paradox is this: on the surface, things still look relatively fine. The market has not crashed, unemployment has not exploded, consumer spending has not collapsed, GDP is still rising. But once you dig into the data, the picture starts to look very different. Businesses are drawing down inventories instead of making new investments. Exports are rising, but much of that increase is coming from gold and silver. Consumer spending is rising, but mostly from higher income households. Spending is increasing sharply in healthcare and pharmaceuticals, which are hard to cut expenses, not necessarily signs of stronger consumer confidence. In short, the economy has not fallen into crisis, but that does not mean it is truly healthy. It may simply be held up by 3 temporary support pillars. In the next section, I will break down each one. The first reason, and the biggest one, is AI infrastructure spending. You hear about AI all the time, but what many people still do not fully grasp is just how massive the money flowing into it has become. This is no longer just about AI helping people work faster. There's an entire ecosystem behind it. Data centers, GPUs and chips, electricity, power transmission, cooling, cloud infrastructure, enterprise software, and all the supply chains connected to it. Just a handful of large companies are spending so much on AI infrastructure right now that it is doing something very important. It is helping keep many macro indicators looking healthy. But there is one detail that really matters. If you look at net investment across the whole economy, the number may not be as strong as it feels. That is because the increase from AI capex is being offset by inventory drawdowns. In other words, many businesses are selling off stockpiled inventory from earlier periods. Put simply, on one side, companies are building multi-billion-dollar data centers. On the other side, many businesses are liquidating inventory just to preserve cash flow amid tariff uncertainty, cost pressure, and policy instability. So the real picture is this: AI is pulling up the good-looking growth numbers, while many other parts of the economy are weaker than the surface data suggests. And if AI spending slows down suddenly, the weakness underneath could show up very quickly. The second reason is the wealth effect. This is why you see a strange split-screen economy. A lot of people say the economy feels difficult, small businesses are under pressure, but malls are still busy, travel is still strong, and high-end restaurants are still packed. Why? Because at this stage, spending is no longer reflecting society evenly. A large share of consumption is being sustained by people who own assets, stocks, homes, and financial assets. When asset prices rise, they feel wealthier, at least on paper, so they keep spending. This creates a macro-level illusion that is easy to misread. GDP still looks solid. Top-line revenue still looks okay. Markets remain supported. Meanwhile, many lower and middle-income households may have been cutting back for a long time already. This is what a K-shaped economy looks like. One branch moves upward because asset prices rise. Another branch gets squeezed by living costs, borrowing costs, and day-to-day financial pressure. What is more concerning is this: even part of the higher income group is starting to overspend, rely more on credit, and show signs of financial strain. In other words, this factor is still helping prevent a sharp drop in consumption. But that does not necessarily mean the economy is healthy. It means the economy is becoming increasingly uneven. The third reason is a combination of 3 forces: market psychology, policy expectations, and access to credit. In plain English, the market believes that if conditions deteriorate too quickly, policymakers will have to step back. A scenario many investors are quietly pricing in looks like this. Tariffs rise, markets react sharply, then policies get delayed, adjusted, or partially exempted. When this happens a few times, markets begin to build a belief. There is a pain threshold policymakers do not want the economy to cross. That belief becomes a psychological cushion for markets, and it gets reinforced by one more critical factor. People can still borrow. Credit cards, installment financing, and consumer lending are still functioning. Large companies can still access capital, and AI is still attracting huge flows of money. When all of these forces exist at the same time, the system can keep moving, even while the foundation underneath is getting weaker. That is why you see a strange phenomenon. There's a lot of bad news, but the major indexes are not reacting as negatively as many expected. Not because the economy is immune, but because right now it is being supported by very large pillars that are uneven and not durable. And this is the most important part. Why is the sentence, "the economy has not broken yet," not necessarily good news? Because when you look deeper into the data, you see that many of today's strong-looking numbers come from sources that are hard to sustain, do not reflect true underlying health, or are simply mandatory spending. 1. Trade looks strong, but the quality of that strength is weak. Lower imports can make GDP look better. Higher exports can also make GDP look better. But if imports are falling because businesses are drawing down inventories and exports are rising mostly because of gold, silver, energy, or defense, that is not the same thing as a broad production boom. It looks more like this: selling valuables and using stored inventory to preserve cash flow. In the short term, the numbers can still look good. In the long term, that cannot carry growth forever. 2. Consumer spending is rising, but much of the increase is in hard-to-cut categories. A large part of spending growth is coming from healthcare and pharmaceuticals. These are categories that are hard to cut, not necessarily signs of stronger confidence, and often associated with an aging population, higher illness burden, and rising system costs. In other words, higher spending does not automatically mean people are doing better. It can also mean the cost of living and survival-related expenses are rising. 3. A weaker US dollar can make the picture look better on paper. When the dollar weakens, some things can look more positive. Exports become more competitive. Some domestic assets rise in dollar terms. Certain nominal indicators get support. But the US is a large import-dependent economy. So in reality, a weaker dollar plus high tariffs means more expensive goods. And the people who feel that most directly are usually households. So yes, the reports may look better, while real life gets more expensive. 4. Long-term risk. The economy can weaken in quality. If the system is being held up mostly by mega-cap capex, asset wealth of the rich, credit, and the expectation that policy will intervene when markets get too painful, then the economy can easily drift into a state that is more concentrated, less competitive, harder on small businesses, and strong on index-level numbers, but weak in broad-based prosperity. And if you go further down that path, you can end up in an environment where being close to capital, power, and policy matters more than building a better product. That is when markets can still rise, but the real economy starts losing vitality. So what should you do now? Do not try to predict the exact day the market turns. Do not chase headlines every day, and do not assume everything is fine just because indexes are still high. First, focus on the quality of growth, not just the speed. Do not just ask, is GDP growing? Ask, where is that growth coming from? Who is spending? Is investment real capex or inventory liquidation? Are exports driven by manufactured goods or by gold and silver? Just changing the question helps you see the difference between real growth and growth that is being propped up. Second, follow money flows, not just narratives. Narratives change fast. Today, AI is the growth engine. Tomorrow, it is the threat. The next day, it is buy the dip. But money flows tell you more. Which sectors are getting real capex? Which sectors are living off the story? Which sectors are oversold? Which ones will struggle if credit tightens? Third, if you are a small business owner, a worker, or a content creator, the practical lesson is simple. Reduce dependence on a single income source. Preserve liquidity for longer. Prioritize essential demand. And do not build plans around the assumption that policy will soon become stable, because the system may not break immediately, but volatility usually knocks out the thinnest capitalized players first. If the economy has not broken because it is being supported by AI capex, wealthy households' assets, credit, and the expectation of policy intervention, then the real question is this: is this genuine strength or just a way of buying more time? If you found this video helpful, Please like and subscribe so you do not miss the next one. Thanks for watching, and I will see you in the next video.